would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. Welcome to it, folks. Thank you so much for joining me. I do truly appreciate you spending your valuable time with me. I hope that you find today's show worth it. If you'd like to get in contact with me, head on over to the website at therebelbroker.com. In the menu bar, just click on Contacts. From there, you can send along any ideas, suggestions, observations, or questions that you might have. I'd be happy to share whatever comes into my mind relating to your question or whatever your inquiry might be. I think we're going to go ahead and make it official. It looks like for the very first time we've got someone who either doesn't check their email very frequently or they used a email they just don't use to submit their entry into the Amazon gift card drawing. So unfortunately, we're going to have to go for another person. We're going to close off, since we're so close to Friday, we're going to go ahead and do that. We're going to close it off at Friday, 5 p.m. Pacific time this week. So if you're hearing this before May 19th at 5 p.m. Pacific time, head on over to therebelbroker.com, click the big red button at the top of the page, titled Take the Survey to Support the Show. Use the same email address both times you're asked. Make sure it's an email address you check. Answer the demographic questions, and you are in, and you've helped the show. Thank you very much. And you've also gotten yourself in the drawing for that $50 Amazon gift card. Okay. We've got a couple of interesting stories, a handful. A small buffet of articles that I think all kind of play into each other pretty interestingly because we've talked so much about keeping our eye on debt, right? We've and this is sort of a house being analogous to a theory that I've been building now for at least a year and a half, that we need to not focus on singular bits of debt, but overall bits of debt. And there's a few interesting nuggets to that today that kind of fit in. And this is actually kind of an interesting week. We've had a couple of different interesting topics this week as it relates to debt and sort of the public trend. And I think what I want to do is start with our first article today. Now, this one's coming to us from Calculated Risk. But this is from the New York Fed, and it's the Household Debt and Credit Report for the first quarter. And the numbers are a little bit creepy. The headline is that household debt now surpasses its peak that was reached during the recession in 2008. Now, the first thing that's interesting to note about this is that there are some folks out there trying to sell this as not something to worry about, saying that this time Americans are doing much better handling their mortgages. And that's what the Los Angeles Times is really pushing as their headline. Credit cards, auto loans, and other borrowing. The data from the Federal Reserve Bank of New York, according to them, shows that we're doing a better job handling all that debt. And that may, depending on the snippet of time in which you look, that may be true. And there are some elements of debt that we're doing better with than others. Now, remember, there's big problems with student loans, which is the last time I looked, God, I saw a number earlier today that was 2.6 trillion. And I can't remember if that was student debt plus auto loans or if that was just student debt. The last time we looked at just student debt, it was 1.31 million, which is already more than the 1.31 trillion, which is already more than the 1.3 trillion that was the peak of housing debt. So why is there more confidence now? According to the report, consumers are delinquent on 4.8% of their total debt, a marked improvement from 11.9% of debt that was at least 30 days late at the end of 2009. I got to be honest, I don't take a lot of comfort from that number. It would be nice if they sort of broke that down into the areas of what is the actual delinquency on the various pieces of debt that they're talking about. But there's one other element to this that we're going to talk about in a minute that is a little bit more scary. And it feeds exactly into what we've been talking about here for over a year, in that the theory I was pitching was that you needed to worry less about what the debt was. If the debt is the debt, right? You find yourself burdened with a certain kind of debt or a certain amount of debt. You come to a point of desperation in your debt where you have to make hard choices, and you tend to prioritize things the same way, regardless of what the total amount of debt is, right? Now that may shift a little bit. There may be stuff around the statistical edges, like maybe you want to try to pay off a debt that's much smaller first to simply get it off the book, or maybe maybe you're doing some sort of calculation in your head relating to interest rate, impact on your life. Who knows? The probability you think you'll suffer a penalty for being late or not making the payment. I think all these things play in, and I think what you end up with is sort of a similar reaction. I think that statistically you'd probably see maybe a little bit of variation, but a similar reaction to the burden of debt that you're having to deal with. Total household debt reached $12.73 trillion in the first quarter of 2017, which finally surpassed the $12.68 trillion peak reached during the recession in 2008. This was a 1.2% quarterly increase and nearly 3 years of continued growth since the long period of deleveraging following the Great Recession. Now, it's also kind of interesting to note the makeup of this debt. And I've posted to Pinterest the chart that's included with this report. And of course, I'll also include a link to the story in the show notes if you'd like to check those out. You can find those over at therebelbroker.com. In addition to that, you'll also be able to find links to joining the Rebel Underground and also to getting involved with Audible, a sponsor for the show, if you'd like to help support the show, if you're interested in doing Audible. But if you look at the makeup, the amount of this that is racked up in student loans is far more than it was before. I mean, probably 3 times the amount that we saw back in 2008 to 2009 timeframe. Credit cards looks to be about the same. Auto loans are a little bit bigger, and revolving credit looks to be less actually than last time. And actually mortgages are less than last time. And this is all in trillions of dollars on this chart when you check it out. And there's one other chart that also goes with this that's a chart of the total balance by delinquency status, which is super interesting because the delinquency status on this, or the amount of delinquency, ramped up gigantic after the first quarter of 2008. And that's really when we're sort of comparing ourselves. So if we're comforting ourselves with the numbers we're hearing right now on the levels of delinquency, and we're expecting some sort of similar trend to occur, right? Which would indicate an increase in delinquency. Well, then we should be concerned, because if we think that we are in a similar situation to where we were then in terms of debt, in terms of attitudes towards delinquency, we're likely to see this number grow over the coming quarters, not decline. And now this number appeared to peak in the first quarter of 2010. So from 8 to 10 is really when that big growth started to happen. And then the delinquency status started to decline. And the interesting thing about this is it breaks it down by how late was it. So severely late, we are, interestingly enough, at about the same place in terms of dramatically late. It looks like we're in the same place, maybe a little bit more in terms of the 120 days late. About the same in 90 days, as far as 90 days, but it looks like we're quite a bit less in terms of the 60 days and quite a bit less in terms of the 30 days. So those folks at the early stages aren't as plentiful as they were in the 2008 example. Well, actually, they had a lot more. Yeah, those numbers actually jive. So it'll be interesting to see how this plays out. Now, over the next quarter, what we're going to want to look to see is, do we start to see more folks entering into that 30, 60, 90-day time frame in terms of delinquency? And that's all sort of the lay of the land. Those are numbers I wanted to give you this broad view. But there's one other element to this that I wanted to talk about that is the more concerning part. But we're going to take a quick break before we do. Don't go away. We'll be right back to discuss what I think is probably one of the most scary elements of this equation, and it hits us directly in real estate. So don't go away. We'll be right back.
Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right. Aside from hosting this show, I am also the owner broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909.
Welcome back, everyone. We're sort of surveying the debt landscape right now and trying to pin down where we should be the most concerned. My running theory has been that we'll treat the debt we have the same way we treated it last time. We'll regardless of the aspects or the angles that the debt come at us, we'll sort of go through that same mental gymnastics of prioritizing, whether that's formal or informal, right? There's going to be folks who very smartly sit down, make some very rational decisions about what needs to happen relating to what debt. Sadly, that's a very small percentage of people. The process I'm referring to could just as easily be a wild, irrational choice that for folks who actually think about what interest rates are doing to your debt and how much it's accruing over time and all that stuff might make a totally different choice based on much more rational analysis. A lot of what happened last time was not based on rational analysis. And a lot of decisions that were made last time didn't meet what you and I might describe as rational, but were realistic. Folks who made choices like, we're about to go bankrupt. There's no way we can pay for this house anymore. So we're going to buy the house across the street, get closed and out of escrow, and just leave this house that we're in. Right? Those were things that were happening. For those of us who sort of play this thing by the book, doing that kind of stuff just doesn't make a whole lot of sense. But if you in your head have got this conclusion because you've seen it happen with other people, that when these things happen, it only follows you to prevent the next purchase. Well, if you do that purchase before the bad thing happens, you're set. People who make decisions based on the idea that, you know what, I can just stop making my payments and just stay where I am because the process to get me out of this house takes forever, right? So there are those of us who understand that, you know, we've signed an agreement, and if something goes wrong, we have to get out and move on and let the folks we owe money recover in whatever way they can, based on the value of the asset that we were getting the loan on, which is the house, right? A lot of folks realized that wasn't necessary and that you could simply stick around and ride it out for a very long time. I can't remember what the record was, but back when we were talking about this stuff regularly, I seem to remember covering a story where someone had been in a house for 4.5 years without paying rent or mortgage or anything, trying to go as long as they could through this mortgage process. All right. Here is what I think will happen, and here is an article from Housing Wire, which is discussing some information that's come from TransUnion. And these are loan data people. These are credit people. This is what they know. And the payment or the payoff thing here is that Americans will stop paying mortgage before their car payments and other loans. Personal unsecured loans hold the lowest delinquency rates. And that's an interesting thing to think about, right? Because, we all know that if you stop making payments on your car after a certain amount of time, the repo man comes and takes it. So the mindset we've just sort of penciled in over the last couple of minutes is this mindset that, well, no one's going to come and take my house. That process takes far too long. So I'll be able to stay here for some period of time and bank that money instead of paying off my mortgage. So what we find is folks typically tend to prioritize the mortgage. And I think to a great degree, this is a learned behavior. This isn't, well, you know what, we haven't lived up to our financial obligations, so now we have to move on. It's in the real world, they can't get me out of here very fast. So what's amazing here is this breakdown of what they will and won't pay. So according to TransUnion, this is just really kind of a mind blower. And I hate it when some things I make an estimation on end up being true, because it's sort of distressing, particularly when it's something we've been through before, right? I mean, this is not unusual territory. This is territory we should all be very familiar with. We've all been here. Anyone who's been around since 2000 and gone through 2006 through 2010 should get it, particularly those who were in the business of finance at that time. According to this quote, it is quite surprising to us that for most struggling consumers, unsecured personal loan payments are prioritized over other prominent credit products, such as mortgages and auto loans. And that's according to Ezra Becker, who's a senior vice president and head of research for TransUnion's Financial Services Business Unit. She goes on to say, quote, while personal loans have existed for a long time, recent growth in the number of such loans led us to explore this product's position along the payment spectrum. The prioritization of personal loan payments above all others is counterintuitive, but our study results are clear. We believe the relatively short duration of these loans, usually less than 30 months, is a key factor in the decision process of consumers. This chart shows delinquency rates after 12 months for consumers who possess and are current on all four credit products at the beginning of the prospective performance measurement period. So there's a table that goes in with this. One is a personal loan, one's an auto loan, one's a mortgage, and one's a credit card. And the delinquency rate takes a huge jump for mortgages, far greater than all others, far greater than personal, auto, or credit. I actually, and this is where it's theory time, right? This isn't me pointing to research. This is me sort of trying to have a chat with you about what causes this. When you think back, when you think about the repercussions of not doing something, what's the burden that you have to deal with? If you stop making your auto loan payment, what's going to happen? And fitting in with that, your auto loan payment appears to be the one that has the least amount of growth and delinquency of all four of these. Now, why is that? Is it because you feel more duty bound to maintain your car payment? No, it's because folks know their car will disappear in the middle of the night. Now, I think TransUnion makes a good point here. They think the reason for lower delinquency rates among personal loans would be because of the shorter time frame. I think that's a realistic thing too. But I think also an understanding in their minds of the penalties involved is there. Unsecured personal loans average 28 months as opposed to an average 60 months for cars and 230 months for mortgages. Quote, we conjecture that personal loan borrowers may feel they can get a quick win with these loans even when they are struggling, and there is a clear near-term end to the obligation, a light at the end of the tunnel. So that, I'm sure, plays a part as well. They go on to say, in contrast, auto loans and mortgages have much longer terms, and credit cards have no set end date. Finding an opportunity to pay a debt in full can be a powerful motivator for a struggling consumer. But again, also bear in mind that they are prioritizing car payments over mortgage payments. In terms of the growth, right, of these numbers. Now, the number one most delinquent thing that consumers pick is the credit card. When they find themselves in difficulty, it jumps up to 3.6% are defaulting. And the next highest is the mortgage at about 2.5. And then, let's see, auto is 1.8 after that fourth quarter, and personal loans are about 1.4 or 1.5. Very interesting prioritization. But anyway, the point here is this is the kind of stuff that can kick off those dominoes we were talking about. When folks stop paying their mortgages because of debt, because they finally found themselves in a crunch. That's the sort of thing we're looking for. That's the sort of thing that went down before that really got us into so much trouble and started this relatively quick degeneration of the marketplace and really brought the market to its knees. So kind of kick that one around in your head. I think it's a concern. I think this is something that could be one of the first indicators or at least setting the stage for circumstances that would lead us to another scenario where we're facing a difficult marketplace. Now, the most recent numbers for lending have come out, and according to CNBC and some other outlets, mortgage volume has dropped 4.1%. Now, remember, it was just a week ago that everyone was talking about how all the millennials had come out, right? And we were arguing this week that didn't really seem to be the case. A lot of data sure did show that there wasn't a big upswell of interest on the part of millennials. And so we were making the argument here that maybe as a percentage of overall buyers, millennials were making up a bigger percentage, but that the total number of buyers was already relatively low. And the reason why we're still seeing these crazy growths in prices is simply because despite the fact there's low numbers of buyers, the level of inventory is so ridiculously low that it simply makes prices higher because those two relative things are totally out of balance, right? Despite the fact we have fewer buyers, we have much fewer listings. So the end result is you end up with fewer sales and higher prices. And that's the one thing that's been consistent. So what's interesting here is you can also look at this and say, well, this is clearly a thing indicating less volume in sales, but that could also simply be a factor of the inventory playing a part. But this could also be one of those pivot points we've talked about in the past. Let's see. According to this article, the drop may be due in part to higher home prices and in turn fewer entry-level buyers able to afford a home. Total application volume fell 4.1% on a seasonally adjusted basis from the previous week. The Mortgage Bankers Association's weekly tally was nearly 16% lower than the same time next week, or the same week 1 year ago. So we're off from a year ago. Now, here's the data I'd like to see from this, because what I would want to know is how many folks actually reached out to get pre-approved for a loan. That's the number. That's what you need to know. How many people want to buy? And then this number sounds like it probably reflects folks who actually completed the application process to purchase. In other words, to work towards a funded home, which means they've already found one and gotten into contract in it. Applications fell 3% for the week, but remained 9% higher than a year ago overall. The survey, quote, saw relative weakness in the growth of government application volume, suggesting that many potential first-time buyers remain on the sidelines due to the lack of entry-level homes on the market. Now, one good ray of sunshine coming out of this is now this kind of a statement. This was not what we would hear from places like CNBC just 4 or 5 months ago. The quote would have been, not lack of entry-level homes, but lack of enough programs to support financing for larger numbers of people, right? There was all the headlines were about outreach programs to bring lending to a broader base of people. And the translation into real money English on that is create more subprime lending, embrace lending to folks who are less qualified to borrow. Now, higher interest rates over the past few weeks weighed on refinance volume. That's absolutely true. But I'll tell you what, anyone who's, again, trying to complain that current interest rates are what's keeping people from buying homes are not paying attention. This has got nothing to do with it at this point. And if I'm sure you could probably find a single case somewhere where someone said, I decided not to buy because of interest rates, and that would be one of those less than 1% people who did that. I'm simply not seeing it. The worst thing I've seen in the last 2 weeks was someone who was unable to get pre-qualified for a loan because they'd screwed up their taxes for the last 2 years. That's it. And I've worked with an awful lot of folks with challenging financial situations who've managed to overcome those. And nobody is worrying about interest rates. The 4 to 4.2% range is, no one is getting upset about that. Okay. I hope that this doesn't depress you. You know, maybe I need to get more into a regular process where I save the more upbeat stuff for later in the week so I don't make you depressed during your weekends. There's so much stuff here, whether we're talking about what Americans will stop paying first, or where debt is. We have got a crazy mix of stuff that could really play a part in the market in the near term. And it is stuff like this that really convinces me that, yeah, you know, I'm probably going to be doing a smart thing by selling my house sooner rather than later. So again, and on that front, I will give you updates relating to what goes on there. I'm now weighing whether or not focusing on getting in this window of time between now and next month to get on the market should be my limiting factor. We'll see. I'm having chats with contractors, and we'll see how all that stuff goes. All right, folks. Truly appreciate y'all listening to what I have to say on these subjects, and I hope it's beneficial for you to cover this information, at least something for you to bounce around in your head over the course of the day. Thanks for listening. I'll talk to y'all next time.